Yeah, hello everybody. This is now a lecture on Anti-Tax Avoidance Directive, the German Foreign Relations Tax Act, and comparable rules against tax-saving models in international cases. And we will always refer to the lecture in an abbreviated way, calling it the Foreign Relations Tax Act lecture, yeah, but this is rather yeah, unimportant. Well, what is this lecture going to be about? Simply about the rules in the German Foreign Relations Tax Act, naturally. And this tax act is sometimes also translated as the External Relations Tax Act. That's, for example, the name which the official translation obtainable from the website of the Federal Fiscal Ministry, the Bundesfinanzministerium, has chosen. This is a good illustration for what we always told you, that it's difficult to translate technical terms into a foreign language, and that one always should mention the official term in the original language, because here you can already see if one tax consultant or one speaks of the Foreign Relations Tax Act and the other one speaks about the External Relations Tax Act, then if somebody from England, US, South Africa, or where else then gets into contact with both of them, that poor guy or girl can't find out if both conversation partners speak about the same thing or not. So keep in mind and memorize that the official designation or denomination is simply Außensteuergesetz, ASTG. Naturally, you are probably not able to memorize or pronounce correctly Außensteuergesetz, so just call it ASTG. That's the abbreviation which everybody in Germany uses. It's an official abbreviation, and so if you cite something in that tax act by paragraph 1 or paragraph 2 ASTG, every German familiar with tax law will directly know about which thing you are talking. So use this abbreviation if ever you refer to that tax act, and do not create own English abbreviations. That might be a nice idea, but will in practice be totally confusing or even irritating, because the people first have to understand the meaning of your self-made abbreviation, then to translate it, and then to guess what you are talking about. Good. Now again to the question, what is this lecture going to be about, ladies and gentlemen? Plain and simple. In your first semesters or during other playlists which you looked through here on the YouTube channel, you have already learned some basic rules about taxation, especially also in international context. And now you know people always want to design their behavior in a way that taxes are minimized. That's a natural and legitimate aim which people have. Tax is money which is taken from you by force. You are not even allowed to pay taxes voluntarily, and so it's recognized officially that every person will have the instinct to escape taxation as far as this is possible under legal conditions. Well, and when do you have possibilities to escape taxation in a legal way? When? Well, when you can change your behavior in a way which then doesn't trigger a tax or triggers a lower tax. So people might use the rule of international tax law in order to achieve the application of rules which end up in a lower tax level for their profit or for other things. So then it would be under normal circumstances, and that would be called a tax saving model. And now these tax saving models, are they unwanted? Naturally, they are, probably. if the tax legislator especially did not foresee that you had a possibility to escape the application of a rule which leads to a high tax level, or at least did not want you to use these loopholes, then the answer is simply yes. These things are unwanted, and so the legislator will worry about possibilities. What can we do against people profiting from, let's call them cheaper rules abroad, or cheaper, more favorable rules in an international context, if we do not regard that as okay? Well, so, well, how does that work then? Whenever you can replace one behavior which triggers a tax by another behavior which ends up in similar results economically, but does not trigger that tax or does only trigger a lower tax, well, then people will do so, at least if they know about the possible choice. This is in principle not illegitimate. It might even have a very positive effect, because if your law treats two behaviors with the same economic outcome differently, then in your law there is an inbuilt injustice. Although two people have a comparable ability to pay, they are taxed differently. And now when people use their tax-saving opportunities, the legislator will be forced to react and to remove the different treatment of the two comparable alternatives, or the higher tax rule will in practice die out. So within a national surrounding, tax saving is rather a positive thing, because it triggers a kind of evolution of tax rules, a survival of the fittest, in order to end up with more fair and equal rules for equal behaviors under an economic aspect. Now, when you look now for an international context, things get a bit more complicated, because in a purely national arena, the legislator can react, or legislator even wanted certain tax-saving opportunities to exist. And they can prepare for it, because they can overlook their own system. So, for example, in Germany, if a house is held as a private property, so within types of income like lease and rent, then you can sell it after a certain while completely tax-free. This is a well-known possibility to generate income which might be tax-free. On the other hand, business property is always taxable when it's sold, so holding a house within a business property is less attractive. That leads within Germany to the existence of numerous tax-saving constructions where, for example, business owners don't erect a building on their own, but just cause somebody else to construct a building and then move in and pay rent to the owner, and the owner sells after some 10, 15 or 20 years with a huge gain without paying tax. And both, by working together, both profit from this cheap alternative behavior. So the market uses these things, and the legislator chooses deliberately to leave that loophole or that tax-saving opportunity open, so nobody can be reproached to use it. But when the majority of people sees something as an unjust and unfair opportunity, naturally Parliament would react. Now, in an international arena, circumstances are different. First, here you always have differences between how a certain transaction is treated under your inland law and the law of 1 or 2 or 200 other states abroad. So you will always find another tax rule which treats the same transaction in a way that a lower tax occurs. So in an international arena, you always have alternative treatments at hand which are more favorable. And now, this is something which the inland legislator cannot alone react to. Let's say, imagine the German legislator would once be fed up with all the people constructing buildings in private property and letting them for rent to businesses, thereby exploiting the tax advantage of private property. Imagine they would say, now it's enough. Then they could remove that difference immediately just by changing the law. Now, in the international arena, the difference comes from two different laws made by two different states. And now your own state can't remove the favorable alternative treatment in another state. We cannot increase the tax burden in the Bahamas or in the Bermudas or in any other state with B. So we can only change our own law. And so there one might have an idea to say, okay, if we can only change our own laws, our reaction to international tax saving opportunities living from different tax rules here and there can only be to introduce specific additional tax rules for those people who use these tax saving opportunities in a way that if there's something which we don't really want, that then the tax burden is increased again to the level which it would have had without that tax saving construction. For example, to put it plain and simple, imagine you now invest not in Cologne but in the Bermudas or in the sovereign entity of nearly have no tax, where the tax is just 1%. Now, here in Germany, it would have been 45 or so. Well, that is an immense tax saving effect. And now let's say the legislator comes to the idea there is no legitimate motive behind that. You just went to the country of nearly have no tax in order to escape the German tax level. No other genuine convincing motive was behind that. So your only motive was run away from German taxation. Well, in that case, we can't change the law of nearly have no tax. They say 1%, it will be 1%. The only thing we can do is change our law. And the natural reaction would be, okay, we make a change into our law and say everybody who invests in the country of nearly have no tax has to pay an additional tax of 44%, so that the total tax burden ends up again with 45%. So we make that tax saving construction usually senseless by creating additional tax law. So now it's no longer possible to avoid legally the home state tax level in the situations where a state says, well, there's somebody is doing something which I regard as not nice. It's enough. I'm fed up with that. I'm going to take away the tax advantage by just creating a specific rule which then increases the tax burden back to the normal tax level, which I find okay. Very often you have an additional problem. Imagine that you don't want to ensure that foreign investments always have your home state tax level. This is, for example, the problem for Germany, where we have the exemption method usually in DTTs. Then you have to decide which foreign investments are tax saving models, so motivated mostly by tax motives. So where people only want to escape the home state taxation, or where there is something where the investment is made for non-tax purposes, and so living with the foreign tax level would be okay for us. So we have to decide what is to be fought against and what not. And the problem is, very often you have that problem that a German tax inspector knows about the differences in German tax law, knows that, for example, you can use private property investments for tax saving, and knows this is okay. Or would see where it ends up as a tax abuse. Now, in an international surrounding, the problem is you only get the information, I, the taxpayer, did this in the country of nearly half no tax, and I did this and this, and it might be that the tax officer working on your case does not even understand what the tax consequences in nearly half no tax are. Might be that no one in the German tax administration has up to now realized that you have a construction which ends up in a fantastically low taxation, and that it's entirely driven by tax, although it does not seem as such. So it might be that a tax planning or tax saving construction is not recognized and examined as such, so that the question of tax abuse is not properly investigated, or that the legislator just doesn't realize that a countermeasure by special legislation might be adequate. So more and more, there is also a need to create information duties, information obligations for the people involved. For example, a few years ago, the European states have introduced an obligation that international tax-saving constructions must be communicated and explained by the taxpayers or by the tax advisors, by anybody who sets up such a construction and sells the idea to others, that they have to explain and communicate officially these tax-saving or potential tax-saving constructions to the fiscal authorities so that they can check them properly. Yeah. So international tax-saving models are more complicated to counter for the legislator than the inland cases, because you have to live with the foreign legislation and you can only react within your own legislation. By the way, that will usually lead to the effect that anti-tax saving rules are usually complicated because they are designed for cases where the legislator, when we made the national rules or when we made the double taxation treaty rules, did not foresee what might happen. They are usually an idea or a behavior which is not plain and simple, because otherwise the effects would have been foreseen. And so you have to have a good knowledge to understand what's going on. When you see the tax-saving opportunities, then you usually can understand the reaction, and then you can understand why a certain thing is in a complicated way designed just to take away the fiscal advantage from just this. So the usual reaction is, if you profit from a lower tax in a foreign country like nearly half no tax, and we regard that as unfair, illegitimate or so, we cannot remove the low tax level of nearly half no tax, but we will introduce additional rules designated or directed directly and immediately at that behavior which we found unfair, and we create an additional tax burden just for the people who behave in that way, so that in the end they end up with the normal tax level which they would have also had if they had invested directly at home. And naturally one tries to become informed about such potentially unfair behavior, so informational duties will also be put on the taxpayers in question. Well, You should remark, by the way, that beside all these legal things, you exploit the rules, you change over to another state in a legal way. That's the attractive thing. There are also people who use foreign countries in order to commit tax fraud, so for illegal tax saving models. In that case, it makes no sense to create additional tax burdens, because if someone already does not comply with the existing laws, these people will also go on and not comply with future laws. In that case, tax fraud always is a question of control. You can combat tax fraud only by control. And here the basic problem with countries abroad is that the inland, for example, German tax officers can't go to a foreign country and investigate there. So there they are dependent on the information they get from the taxpayer, and they can't check it on their own. So that is the basic thought behind tax saving models which operate in an illegal way. The idea is I do something abroad and they can't find out. For example, I hide money in a foreign bank account. So naturally, these tax saving, tax fraud models, let's call them honestly, tax fraud models have increased more and more with globalization, and so also the the need to counteract these things has increased. So here, more and more cooperation, more and more possibilities to obtain information about what's going on abroad has been created by the states. Usually, you undertake steps to find out what's going on. Either you make agreements with other states about exchanging information. So if the German fiscal authority wants to know something about what's going on in Spain, we can't go to Spain and look there in person, but we can ask the Spanish fiscal administration, could you please help us and look up if certain information is correct, which the taxpayer gave us, or can you look for hidden information? Very often you even have a well-established flow of information between both sides. So if a Spanish tax inspector comes across a piece of information which he or she might find interesting for the German side, they spontaneously communicate that without request, just as a service to their German counterparts. We thought this information might help you. For example, somebody has done something here in Spain, obtained some money. We thought that might be interesting for you. Very often you have even international rules now about automatic information exchange. For example, the interest which you get on a foreign bank account is nowadays usually automatically communicated to your home state. And this system, in the meantime, covers, I believe, more than 100 states of the earth. And the other states which do not yet cooperate are usually more and more cut off from the international financial system. So there is a very immense pressure to exchange information, and more tactics are developed to force the states which do not want to cooperate into cooperation. So very interesting and fundamental things are going on the global level during the last 2 or 3 decades, because fiscal sovereignty is still officially held high, but in reality they have all seen that in a global world they can only survive if they work together, and more that's even enforced by economic pressure, and because otherwise things couldn't work anymore. Germany, I don't know if other states also do that, has even developed a more interesting and fascinating way to deal with states which are not cooperative and do not pass on information, especially with private bank accounts in tax havens. The Germans have developed the strategy that where they can't obtain the information legally from the other states, they buy the information illegally in the black market. For example, it has become a well-established way to secure one's retirement fundings by employees in tax haven banks, that they just steal the data and then begin either blackmailing the taxpayers. Please send us 1,000 euro, or we sell on the information that you have here a hidden bank account to your home state fiscal office in Germany. At least Germany regularly shows up as buyer of such DVDs or USB sticks with huge collections. And many bank employees in tax havens have already become rich by doing exactly this, copying all the data on all foreign customers and passing on the data against money to the fiscal offices of foreign state. So this is what happens against illegal tax saving models. So tax saving models have to be distinguished. We deal with the legal ones here because naturally you as future perhaps tax advisors or employees in the tax department of a firm, you will never do something illegal. Would be far too risky. And by the way, your boss doesn't pay you to hide information. That is something which your boss could do on his or her own. Your boss buys you to find creative ways to lower the tax burden in a legal way. The illegal models will mostly be left out by us, but you must understand the fundamental difference. The legal ones work by clever exploitation of the differences or of the possibilities in existing tax rules, so that you cannot be punished. You can even take a megaphone, place yourself in front of the fiscal office and shout to them what you are doing, and they are helpless. They must acknowledge this is legal. Naturally, they will then fine you for disturbing, for making too much noise in in a public place. But this is worth the fun. The illegal ones work by hiding information. By the way, the illegal tax saving models are usually plain and simple. Complicated behavior usually just increases the risk of getting caught. So there they just hide money. The legal ones are the interesting ones. And keep in mind the completely different nature of the countermeasures. If you act by openly disclosing what you are doing, so if you act in a legal way, then special rules increasing the tax burden back to what is normal, and special rules which say, please tell us what you are doing and bring our attention to the fact that this is a tax saving model, that is sufficient. Because legal persons will try to stay within the legal area. That's the whole fun here. And so they will comply with the additional rules. The illegal things, there you have just to improve control by more cooperation with other states, that you can get all the information what's going on in other states. That is the fundamental distinction. And naturally, we are going to talk about the legal tax saving models only. This is our focus in the lecture series here. Oh, good. Are there additional problems of internationalization? Yes, naturally. You also have some side effects from the fact that now your case is not dealt with only one tax or by only one tax administration, but by two of them. And now if you have clear rules which say a bit of your profits have to be taxed in the other country, a bit at home, for example, rules on transfer pricing, then there is still the possibility that the two authorities apply the rules in a contradictory way. And now, as they are two authorities of two sovereign states, you can usually not force them to agree on a common view and to apply the rules in the same way. That can lead to advantages. In that case, it is a tax-saving model. Or in the other way, it can lead to enormous disadvantages if the rules say a certain amount of profit has only to be taxed in one of the two states, but both say, I am this one state. For this additional effect, you also need rules, which, if we have an opportunity, we will mention. For example, arbitration rules or so in a double taxation treaty. This is a tendency or a trend where more and more rules come into existence, but it's a very reluctant tendency, a slow tendency. The states are relatively reluctant to give the power to an institution to force them to hold a common view on what's going on and to avoid contradictory negative assessments for the taxpayer. So this lecture is about, let's just sum it up, tax-saving opportunities which are legal, and especially the countermeasures which tax legislation can or has already taken against them. We have to look who can decide about such measures, and we have ideas for countermeasures on a global level, on the level, for example, of the OECD. We have it on the level of the EU, who has got busy with that more and more during the last decades, and naturally, primarily on the national level of each state, where they design additional measures. What do you need in order to be able to understand the whole thing which is going on? You must be familiar with all the basics of tax law. Limited, unlimited tax liability rules, there are differences there, because otherwise you do not understand how people can exploit the differences. Double taxation treaties, they decide where you are taxed with which behavior, so you must know them and must be very fluent in their application. So if you have still no idea or only a very faint idea of how these rules function, then postpone this lecture to the future. How will we deal with the topic? Well, for simply traditional reasons, we orientate ourselves here on the structure of the existing German Foreign Relations Tax Act. Naturally, more and more anti-tax avoidance rules have been created, which are placed outside the Tax Act, so it makes no sense only to talk about the things which are mentioned in that specific Tax Act. That would be rather arbitrary. So we will try to cover also related topics which show up in other parts of German legislation. So, yeah, you will need this lecture for later being able to talk about international investments, because you will always be confronted with such tax-saving things, or with the risk that something might be perhaps wrongly assessed as a tax-saving model. So you must know where special anti-tax saving rules might come into play and how you can avoid them. Yeah, which chapters do we have to deal with? First paragraph in the ASTG is transfer pricing issues. That is an example for manipulating the tax base by transactions with other business entities, and that leads to the following similar topics, which also should be covered in that context: hidden profit distribution, hidden capital contribution, withdrawals and contributions as basic rules, the interest barrier rule, the license barrier rule, perhaps also the add-back rules in the Trade Tax Act, hybrid mismatch transactions, perhaps. And Section 2 or paragraph 2, extended limited tax liability. Well, a strange thing. It addresses a specific problem where people deliberately change their personal tax liability from unlimited to limited tax liability to profit from differences. And naturally, related topics in that area are all the other topics where the differences between the two kinds of personal tax liability might play a role and might be used for tax optimization. So we will also have to talk about 1.2, 1.3 ESTG, about DTT rules, which sometimes takes special regard to these phenomenons or these German rules. And we also should have to talk about similar rules or the need for similar rules in the field of other taxes, not only income taxation. Paragraph 6 deals with the exit taxation of a shareholder of a company who moves abroad. This is just an example for bringing hidden reserves from the tax sphere of Germany into the taxation sphere of another state. So related topics are shifting the seat and place of management of a company abroad and thereby bringing the shares abroad, or thereby bringing hidden reserves of the company abroad. Also shifting only single assets from the German taxation into the taxation of another state might be a tax-saving opportunity, so also that should be repeated. You could also shift whole firms of a sole trader or of a partnership abroad. Or you might also have rules on that on the DTT level, on the EU level, and so on. So this Section 6 is usually the key word for shifting hidden reserves abroad. Now you might also have the tendency to say, okay, if I don't want to pay income tax, then I must avoid to have an income. The straightforward way, which nobody would ever take into consideration, would be become poor. Because if you have really no income, there is no income tax. But this is rather inconvenient. You would have to sleep under bridges, feed yourself from the waste bins in the street and all the like. So the usual way there is, for example, to give that property and that income to another person, which you have under control. Now, natural persons have an own will. You don't have them under control. So the most popular model, which people already invented in the 1960s or 1970s, was you just create a foreign company, a juridical person, and hand over all your sources of income to that juridical person. Now you can say, I am poor. Everything I had is now owned by my juridical person, and this is somebody else, and that person is not taxable in Germany. And surprise, it never pays out a dividend to me. So, or it only pays 5,000 euro as a dividend to me, although it makes 10 million a month. Tja, surprise. Now on paper, under legal civil law aspects, you are really poor. Naturally, that would be a very good way to escape taxation, and so there is a counterattack by the law necessary. An additional tax is introduced, the so-called controlled foreign company taxation, which ends up by attributing to you a fictitious income, which is just by coincidence exactly as high as the income which you shifted into your foreign company. It's a very nice trick. You pretend you are poor, so you play with the rules of civil law, and the fiscal administration then pretends you were rich, although you are not rich, so both play with fictions. Other related things is using, for example, a foreign permanent establishment instead of a company. Using entities where the status is not clear might also come into consideration here. DTT rules with special regard to such anti-tax avoidance constructions like controlled foreign companies and so on. There might be other things which are possible. Yeah? Then not yet considered within that ASDG, but in general rules, is the need for the improvement on information on things which are going on abroad. This is just the effect that the fiscal administration, although you give them the facts, usually or perhaps does not know about the tax effects, which the final effects are, because they do not look through the whole tax saving construction. So more and more you create, or not you, but the law creates obligations to inform your fiscal officer about the background of a chosen tax saving construction and that you are doing something abroad, so that cooperation with other states can be started. So very often you find rules on that more and more in the General Tax Code of Germany, the AO. You might find rules supporting that also in the DTTs. You might find it on the EU level. And interesting will also be to look more and more to the ways how states try to force uncooperative states into cooperation. Because very often they exert economic pressure rather in a hard way on other states just by, let's say, placing some hits on people who do transactions with uncooperative states. Once they know this, you will be punished, in question marks. You will be punished by non-deductibility of expenses and other administrative burdens, which lead to consequences which are so negative that you will probably cancel business relations with that country completely. And that is why that country will, in the long or medium term, agree to enhanced cooperation with your home state. EU legislation also exists, OECD measures. We have to talk probably about all these things too. Okay, so when we have to deal with all these topics which I mentioned, we will always have an eye on the rules on the national level, the rules on EU level, the rules in the DTTs, not always in that sequence, but this is what we have to do. And yeah, because that is OECD takes measures, EU takes measures, the national states take measures, the most concrete ones usually, for example, in Germany already in the 1970s with several reforms. Since then, the Außensteuergesetz, so the Foreign Relations Tax Act. The US have special rules for international relations, and many, many other states have that too. You will have to deal with important legal sources, for example, the German ASDG and other national tax rules. The ASDG, there is an official translation by the ministry available, at least in the current version from 2020. The DTT rules, including DTT protocols, anti-tax avoidance rules by the EU, and fundamental freedoms of EU law, because they sometimes restrict the fight against or the fight against tax avoidance. OECD recommendations and OECD reports play a role. All that might have an impact, or legislation of the US as far as other states are impacted by that. So this will not be a very easy going thing. Thanks for watching for today. Thank you very much, and see you soon again for the first chapter, which deals with the matter For example, that will be then on transfer pricing and related issues. Thanks very much. Till we see each other again.